Education loan is your best bet when it comes to funding your abroad education studies. GyanDhan is here to help you get an abroad education loan at the best possible interest rates. Let me make it very clear that we do not charge anything for our loan assistance service. In this video, we will be discussing the fixed and floating interest rates on education loans. It is a very common question and students usually have a lot of confusion on this topic. So let me tell you, there is no clear answer whether fixed interest rates or floating interest rates are better. So we will elaborate more on this topic in this video. So let's start. In fixed interest rates, the rate of interest is fixed. Yes, it is as simple as that, and there is no hidden meaning to it. The fixed interest rate that you take at the time of taking the loan is what you are going to pay for the entire duration of the repayment period. Floating interest rates, as evident from their name, has a floating nature and depend on market forces. The floating interest rate may increase or decrease multiple times during the entire duration of the loan repayment. It's the RBI that determines the base rates depending on the market dynamics, and the interest rates are pegged to the base rates. Since fixed interest rates are simple and don't need much deliberation, we will put our focus on floating interest rates. Floating rates are complex and not every banker is interested in explaining all the relevant aspects. The floating interest rates gives us the liberty to take advantage of things happening in the market. If the RBI decides to flush more money in the market and encourage banks to lend more, then you're going to get a great deal out of it. The lowered interest rates will be applicable until the next revision cycle, which is usually yearly, quarterly, or even half-yearly. However, there's a downside to it too. There are instances when RBI pursue a policy wherein they may increase the base rate due to the prevailing market conditions. But one thing that should be clear in your mind is that by market conditions, we are not referring to stock market-like conditions. It's the overall picture of the economy that does not vary absurdly in a sporadic manner. Marginal cost or funds-based lending rate, commonly referred to as the MCLR, is the minimum rate of interest below which banks can't lend. This was introduced by the RBI to make the loaning process more democratic. In the past, there were several instances when the banks were lending to a select few customers at lower interest rates. To counter that, RBI came up with the MCLR. RBI is the banker's bank which lends money to the banks. The rate at which the banks can make money from the RBI by selling securities in case of shortage of any funds is known as the repo rate. So MCLR being linked to the repo rate will have a direct consequence on the loan. A cut in the repo rate will give you less interest rate, but an increment in the repo rate may end up giving you an increase in the interest rates. MCLR also depends on other factors like the operating cost of funds, or the loan tenor, which is the loan duration, etc. The reset period is the time period on which the interest rates will be reset. The bank decides the reset period, and it is a must for every borrower to read the documents and ascertain that the reset period is acceptable to them. It is clearly mentioned in the sanction letter or the loan agreement. The rules pertaining to the reset period vary from one bank to the other, and there is no uniform rule per se as far as the reset period is concerned. The range of variation. hardly varies between 0.25% to 0.50%. Most banks nowadays offer floating exchange rates for a reset period of 1 year. So every year, the rate of change that is witnessed is not an abrupt number, rather a very minimal change. Finally, there is no fixed rule to assess which one is better, but most of the students go with floating interest rates in recent times. Floating rates gives a sense of freedom to the applicant that RBI's policy will make the interest rates low. The flexibility of interest rates reduces the burden on the EMI, providing a significant relief to the students who start earning after completing the course. It also leads to a lot of savings, which is the reason why now banks give the liberty to switch from fixed to floating interest rates. If a student feels it is better to go ahead with a fixed interest rate, even that is not a bad choice. But the recent trends have certainly swayed in favor of floating interest rates. So that's it for this video. If you have any questions, please post them in the comments section. You can check your loan eligibility by clicking on the link given in the description. Thanks a lot.